This is the fourth video of our mutual fund series. And in this video, we'll be discussing about an index fund that has performed pretty good as compared to other index funds as well as many active funds. So in this video, we'll be talking about HDFC index fund Sensex plan. So let's see whether one should invest in this index fund or not, right? Now, see, this fund has been in existence since 2013, and its AUM is near about 3,700 crores, and its expense ratio of the direct plan is 0.20, which is less than what most large cap funds charge. And even when it comes to the regular plan, its expense ratio is 0.4%. So that's also pretty much less as compared to other large cap funds. Now, one important thing is that, see, the happiness of any family, more precisely your family, it depends on how well you plan for your financials. So financial planning is of utmost importance once you start earning, right? Now, see, in this particular video, I'll show you the difference between the direct plan and a regular plan. Specifically talking, I'll be showing you how the returns fluctuate in direct and regular plan, right? So in this particular chart, you can see this for the direct plan, right? In this direct plan, if you see, uh, it has been performing pretty much the same as the performance of the BSE 100 TRI, right? But if we shift our focus to the regular plan, you'll see that the particular index fund, HDFC index fund, it is underperforming by a great margin against the same benchmark. So the performance gap between the direct plan and the regular plan is quite distinct, right? I'll show you different things. See, so this is a basically a table. Just see this thing. This is for the direct plan. On a 7-year scale, it has given a return of 12.7%, while the TRI is 12.88%. It's pretty much the same, right? But if we check the regular plan on a 7-year scale, it has underperformed the index. Even on a 10-year scale, it has underperformed the index, right? So this was a comparative analysis of both the plans and why you should go with a direct plan. You can have this particular comparative analysis as a proponent, right? Now the next thing is the sector-wise allocation. See, it will be pretty much the same as other large caps. The top 5 sectors are financial, technology, energy, consumer staples, and automobiles, right? Now, if we see the basic details, it has given a return of 13.54% since its launch way back in 2013. The expense ratio, as we have discussed, it's 0.20. The risk grade is above average and the return is also high. The turnover is 8.14%. That means the churning rate is quite low, which is quite the normal in index funds. The minimum investment is 5,000 rupees and the additional minimum investment is 1,000 rupees. Afterwards, the minimum SIP investment is 300 only. The exit load is 0.25% if you redeem within the first 3 days, right? There is no lock-in period. Now, when it comes to the best and worst performance, it's pretty much the same. The best performance will be after the 2020 crash, and the worst performance will be before the 2020 crash, since 2019, if I may say. 20 March 2019 to March 2020 will be considered as the period of worst performance, right? Now, when it comes to the asset and portfolio allocation, uh, major completely 99.87% has been allocated to large caps only. If we see the top stock holdings, Reliance occupies the pole position, then HDFC, ICICI, and Infosys. This is my WhatsApp number, and you have my email ID. If you have any query, or if you want to buy a mutual fund or build a portfolio and want an unbiased opinion, a commission-free opinion, please let me know. I'm always available, except the weekend, right? So, thank you so much.